Good evening. I'm in Europe right now, so it is actually Sunday evening, September 17th, 2023. It's about 8:30 p.m. Central European time. It's about 2:30 on the East Coast of North America. Going to make this as laser as possible given the amount we have to get through tonight. First, I want to say that last week I was supposed to be attending the Beaver Creek Precious Metals Summit, but due to a very unfortunate accident that my mother had, she fell in her bathroom, a pretty bad fall, and fractured her hip. So I have traveled to be with my mother, and I'll be here in the island of Malta for the foreseeable future. And subscribers who get my morning alerts sort of know my backstory with Malta. If you would be interested in being a subscriber to my morning emails, please shoot me a message on Twitter or CEO.ca. On Twitter, I'm at CEO Technician. On CEO.ca, I am at Goldfinger. I write a morning email almost, I would say 29 out of 30 trading days, almost every market day arrives in your inbox at the U.S. market open. And it is pretty wide ranging, and there's no specific domain of topics. It's just anything involving the market, anything that's of interest in terms of market, macro, technical analysis, fundamental analysis, junior mining, precious metals, whatever strikes my fancy on a given day. So let's get to it. Let's get right to it. Friday was a bearish trading session in the U.S. equity market. Really pretty ugly. You can take a look here. This is the hourly chart of the E-mini S&P 500. And you can see this was right around the market open. And we just went straight down the first few hours. And market basically closed on its low, 44.99 in the E-mini S&P 500 futures. The fact that there was no lift at all throughout the session, there was barely a bounce from early Friday morning highs in the 45.60s. So we're talking about a 70-point drop in about 16 hours, and there was very little lift at all. And that was an OpX quadruple options expiry, futures expiry, all that good stuff. A lot of volume came through, and you can see it here in the S&P 500 daily chart, the SPY. You can see this big volume uptick on Friday, and look at that candlestick there, that very full-bodied, bearish, gap lower red candlestick. I mean, as far as candlesticks go, this is of the very bearish sort, but also look back, we've had this candlestick here was followed by a slight move lower the following trading session, then a big rally. But generally speaking, when you get these kinds of candlesticks, there is more downside ahead, let's say in the next week. At least, the next several trading sessions, we probably go lower, okay? But I don't think people should get too bearish after Friday. It is just one trading session. If we think back to last weekend's video, I took a fairly bearish view on the market, and I still lean to the bearish side, but from a shorter term trading perspective. So it's very important to clearly make a distinction from shorter term trading, so that could be intraday or let's say swing trading, 2, 3, 4 trading sessions, and longer term, which is a month, 2 months, or maybe even 12 months, right? That's sort of how I segment. Like a month for me is longer term. Shorter term is an hour or a day or 2 days. Um, Shorter term, I don't think that one wants to necessarily get too bearish. Also, next Wednesday is the Fed. We don't know what they're going to say, but it's quite likely they will pause. There won't be a rate hike next week. Obviously, the statement matters, and then the press conference from Powell matters even more. We'll talk about that in a bit. But bigger picture, I mean, we have lower high, lower high. QQQ, same thing. The peak was in the middle of the summer, right here, mid-July. And then we got lower high, and that Thursday looks like another lower high. So generally speaking, that is not bullish. Now, is it overtly bearish? Does it mean that the Qs are going to drop 10% in the next week? No, it doesn't mean that. But I think there's definitely enough evidence for some caution. And I laid it out sort of in a clear, to the point blog post last week called The New Stock Market Mathematics and an Intriguing Setup in Gold, and just basically outlining the breadth of the stock market is not bullish. Small caps making lower lows, lower highs, transports making lower lows, lower highs, industrials, materials, regional banks. All these sectors are lagging way behind the major, indices like the Nasdaq 100 or the S&P 500, which were, as recent as Thursday above their 50-day moving averages. Now, they didn't close above them on Friday. So Friday was a bearish trading session, undoubtedly, and odds are that there is a little more downside ahead over the next week or two. But I don't know how much, right? It's very hard to guess and quantify it. But certainly, I think that a lot hinges on how the Fed chooses to approach things over the coming months. So let's talk about that. So sort of the macro outlook here and the FOMC meeting. So we got some data last week. PPI was hot, largely due to oil and energy prices, right? Gasoline and oil prices ticking up, jet fuel. Just the cost of moving stuff, travel. I mean, anybody who's bought airline tickets in the last few months knows that, right? It is not cheap to move your person or move anything large distances, okay, in this world today, right? So there is strong evidence that inflation has cooled quite a bit in the last year, a lot actually. But there's also evidence mounting now that it is sticky, right? So we're not going right back to 2%. It seems more likely that we stay in the 3 to 4% range, okay? And the consensus view right now, okay, the consensus market outlook is that the Fed has at least one more rate hike left. That could be in November. It could be a bit later than that, but there's at least one more rate hike ahead. There could be even two more rate hikes, right? But there's a lot of things going on, a lot of different key factors coming up in the coming months and certainly over the next year that makes this complicated. And quite frankly, I don't envy the Fed at all. I really don't envy them. This is a very tough economy to grasp and certainly to forecast. It's virtually impossible, right? Everybody was thinking recession in Q4 2022 or Q1 2023. The recession has not come about, and we're still waiting on it. And there's a lot of signs that different sectors or different aspects of the economy are in recession, are in contraction, while others, remain quite robust. So the inflation that showed up in the latest PPI largely had to do with energy. It had to do with this move up that we've seen in oil from 70 to 90 in the last couple of months. So one has to ask themselves, is that oil inflation, essentially, the price of energy, a barrel of oil, something that the Fed can control or suppress by raising interest rates further? I mean, we've already done 500 basis points in the last 18 months. Would another 50 basis points of rate hikes actually be meaningful enough to target oil prices and bring oil back down to 70? And I think any rational human being would have to say no. In fact, and this is very interesting, this Bloomberg article that came out after the Jackson Hole symposium in August, argues that actually raising interest rates further could do the exact opposite. It could create more inflation due to the fact that the supply of whatever it is, goods, services, oil barrels, pounds of copper, will go up because the cost of capital is now restrictive. So by raising further and tightening further, the Fed could actually serve to inhibit the production of the things that the economy needs and consumes in very large quantities, thus raising the price of those things. So while raising interest rates could certainly curb the demand in the economy, it could actually curb the supply too, and it could actually curb the supply potentially more. And you could even take this argument a step further, that actually paying people more interest, so savers getting more interest, now they're earning 5.5% for their CDs or their 12-month bills or whatever they're invested in. They're getting more yield on their cash, which means that they can continue to consume at a good clip because they're earning money, quote unquote, risk free, right? The savers, the people who have capital, the firms that have capital. Meanwhile, the producers in the economy that are trying to produce more copper and more oil and more goods and more services and more seats on an airplane are seeing a higher cost of capital, a higher cost of labor, right? And it's curbing their supply, right? And actually raising prices. It's raising prices. So the Fed is in a very tricky pickle here. And I actually lean towards the view of these economists that wrote this article that further interest rate hikes will actually contribute to inflation, not decrease inflation, dampen inflation. And I think the Fed's most prudent move would be to pause for at least a couple months, at least till November, potentially even till the beginning of the year. But then what are we moving into in 2024? In the US in 2024, we have a presidential election. We have a big election for seats in the House of Representatives, seats in the Senate, and the highest office in the land, the President of the United States, right? This becomes political for the Fed to raise further, tighten further, or to even cut and stimulate is political, right? It could be criticized by either party or both parties or everyone. It becomes a political issue in 2024 for the Fed to make any moves. I think the Fed is really stuck here. I think the Fed is really stuck here. I don't think they have a good move. Certainly not next week. They don't have a good move. We'll see a month from now, 2 months from now, but I think the Fed's most prudent move is just to continue to stay put, continue the quantitative tightening, continue to see the data come in, and see how the long and variable lags of their monetary policy tightening over the last 18 months actually takes hold and affects the real economy, right? Now, on the flip side, if the Fed does decide to tighten further, I think that is decidedly negative for risk assets. That is, if the Fed were to hike again, certainly next week would be a shock, right? But even in November, right? Even any further rate hikes, I think would be very clearly negative for risk assets. And I think if Powell takes a hawkish tone on Wednesday, the market will sell off, possibly quite a bit. And quite frankly, at this point, I don't think he cares. I don't think Powell cares about the stock market until we're at least another 200 or 300 S&P points lower. I don't think that's his concern. I think that's probably number 10 or 12 on his list of concerns right now. The stock market is not his number one priority at all. So if we do get some further downside, possibly even all the way down to the 200-day moving average in the S&P, I think he would be nonplussed, quite frankly. Extractive industries. So just let's use mining, an area of the economy of the market that I have some knowledge and some experience about, right? Like 20 years of it. The cost of capital in the mining industry right now is very high. It's prohibitively high, quite frankly. And for a company to finance a new mine, let's say they've got the permits, right? They're ready to build the mine. They've gotten all the green lights. They've, drilled. They've put out resources and pre-feasibility studies and bankable feasibility studies, right? They've done all the engineering work, and now they need $1 billion to build a mine, right? The cost of that $1 billion now is higher than it has been for a very long time. Okay, I don't even know how to quantify that, but it seems like it's the highest it's been in the last 20 years at least. It's prohibitively high. Okay, to the extent that only the very best projects will get built in this market environment right now, and due to the shareholder value destruction that has occurred in the mining industry in the last 20 years, right? So just think about that, right? So we're not going to blame anybody about the mining failures of the last 20 years, right? There's lots of blame to go around. We can't blame the Fed for hiking interest rates to 5.5%, right? We can't blame the government for an absurdly onerous permitting process and all the stakeholders involved that you have to kowtow to get a mine built, right? Like all that stuff is just, it is as it is, right? But now with, let's say, all this copper that the world needs supposedly over the next 20 years, where is it going to come from? Where is it going to come from? If it's so difficult and so expensive to build a mine, where is it going to come from? And these are very hard questions. And the simple fact of the matter is that extractive industries are the enemy of Western governments today. And the net result of that is higher prices of commodities across the economy. Commodities prices are going up because money is not being invested in these sectors, in the energy sector, in the base metal sector. Forget about the precious metals sector, right? The precious metals technically are not key components of the real economy, right? You don't need gold to build an EV. You don't need gold to build an airplane, but you need aluminum, you need steel, you need copper, right? And you need oil. And now we need lithium, right? We need graphite. So just the fact of the matter is, I don't see a solution anywhere in the near term. I mean, 2, 3, 4 years. There's no solution here. And particularly, the situation will only get worse as long as government continues to wage a war on the energy and mining sectors of the economy, of the financial markets, right? And the cost of capital is high right now. It could get higher, right? And so what we're seeing now is own the commodity, own the pounds of copper, own the barrels of oil, but don't necessarily own the companies that extract these things. That's a generalization. I mean, obviously, there are definitely plenty of companies that have done well and generated shareholder value, but overall, the returns have been subpar if you look back 5, 10 years, right, across the mining sector, the natural gas industry, right, et cetera, et cetera. Okay, I've talked enough about that, but my point is, this is a great article. This is fantastic. It's brilliant, and it makes a lot of sense. And I think people really need to understand this. And I'm sure that Powell is fully and abundantly aware of these risks, of actually pressing on the supply side, okay, more than intended. Okay, so let's move on from that. We talked about this article. By the way, in that blog post, I pointed out Wednesday afternoon when gold was tested. Actually, it was Thursday morning, testing this 200-day moving average around 1925. That, based upon everything I see, all the sentiment gauges that I look at on a daily basis, and just what I see among other market participants, nobody is bullish on gold here. Nobody was bullish, certainly last Thursday morning when we were dropping down into the low 1920s. Nobody actually has confidence that gold can sustain a rally, right? And I would say the same thing for silver. For the sake of time, I'm not going to pull up the silver chart, but the same goes for silver here. I don't think anybody has any confidence in precious metals here, and even less confidence in junior mining stocks, gold and silver, junior mining stocks, right? And actually, the fact that the Fed may actually now be on hold and may actually now acknowledge the risks to the supply side of damaging the supply side of the economy too much by hiking further, by tightening further, could actually be that bullish catalyst, right? We've thought that we need a recession for gold to really sustain a rally above 2,000. While that could certainly be a nice, recipe for a gold advance, it may not be necessary. Okay, it may not be necessary. Did silver juniors and junior miners more broadly see capitulation last week? Well, let's start with the GDX chart. So this is actually producers, gold and silver producers for the week, up almost 5%. And what is this? Yet another higher low was put in place in mid-August, August 21st to be precise, right? So against the backdrop, it's very important that we put market moves, charts into context, sentiment context, right? So the sentiment context here is capitulation level bearishness. People fucking hate the gold mining sector. They fucking hate this sector. Okay, and I say that with emotion. This sector is hated. In fact, it's not just hated by generalist investors, it's hated by the gold and silver diehards themselves as well, because of the performance, the dreadful performance in this sector. It is hated. So I see extreme capitulation level bearish sentiment against a chart that is making higher lows and higher highs, and just ever so slightly these moving averages are beginning to slope upward. I'm not going to say anymore. I think you get the picture. And this is also against the backdrop of the gold rally that we saw at the end of last week from 1925 to 1950, the final, let's say, 30 hours of the week, also occurred against the backdrop of rising treasury yields and a strong dollar. What on earth? Hold on. I thought gold can't go up if the dollar is strong and yields are rising. Something different is happening here. And I think we need to pay attention to it. Talked about GDX. So what happened last week? So I'm pulling up the Philo chart. So first I'm going to show you a 5-month chart. This looks like capitulation to me, ladies and gentlemen. So Philo is gold, or Philo del Sol, or whatever the hell they want to call it. Philo. Okay, it's Philo Mining. I know it's not Philo. That's the stupid American way of saying it. Philo Mining Corp. This is capitulation, ladies and gentlemen. This is what capitulation looks like in a chart, right? 2 months straight down from 2650 to 1950. Suddenly, everybody's washed out. Sell stops are triggered under $20. And what happens? It does a very nice 3-day bullish reversal. And look at the volume on Friday, right? So Philo is copper, gold, silver, the Lundin family, right? So this is like mining royalty, some of the best drill intercepts in the history of the world, essentially, from this company's flagship project, right? It looks like capitulation happened last week. Something changed Wednesday, Thursday, right? Mag Silver, right? This is high grade Mexican silver miner. This also looks like capitulation, and I don't need to draw the line, but just look to the left on the chart here, this 1050 support. This is a failed breakdown under 1050 support, V reversal, and actually it's even more than a V reversal, right? We're looking at some evidence here that is telling us something. Vizsla, another high-grade silver stock, Mexican silver project, right? This looks like capitulation, but it happened in August. So Vizsla is now in a confirmed uptrend. So people are screaming bloody murder about junior mining stocks, about silver stocks. They hate these stocks. They've lost money in these stocks. And look at these charts I'm showing you. Dolly Varden, right? This is high-grade gold and silver in BC. In Canada, Golden Triangle. Look to the left on the chart. Support around 65 cents. Another failed breakdown, it looks like, in this chart. Closed at 75 cents on Friday. So we have a body of evidence for me, and I could show a dozen charts. I could show 24 charts, but you get the picture here. Some of the more important mining charts, junior mining charts, are showing evidence of capitulation has taken place. Plenty of failed breakdowns in these charts, and they're going up now. They're going up at a time when everybody hates them and nobody owns them. Okay? Okay, I'm going to talk about medical psychedelics, MDMA data from MAPS Phase 3 in a separate video. I decided to pull that out of this one just because I didn't want it to be too convoluted, too many different topics, and too long. So look for that one tomorrow, probably tomorrow afternoon, medical psychedelics. And then I do want to mention newfound gold. So I actually forgot to put the bullet point, but so this is what I talked about. I've talked about this a couple times now in the last month, and it's just incredible how consistent the drill results are from this company. And last week they put in an absolute screamer, 47 grams per ton gold over 10.55 meters and 115 grams per ton over 4.1 meters at Iceberg East. And put it all together, I mean, just look at these drill, assay tables. This is really impressive. And just the volume of drill data, of high grade drill intercepts that this company is producing is mind boggling. Okay. There's no other company that's putting out consistent results like Newfound Gold, right? I own it. I do not have any arrangement with the company whatsoever. My conflict of interest is just simply I'm a shareholder and I'm an investor in the junior mining sector, and I would like to see companies have success because we need it in the sector, right? So there's my full disclosure. And looking at the strike extent here, right? So we have high grade segment of 570 meters now, and this is near surface. So this is shallow. It's less than 100 meters depth. So that in itself is very impressive. You know, when you think about a strike extent of 570 meters near surface with these kind of grades, 14, 15, 19 grams per ton. I don't know what the average grade is, and they don't have a resource. So please do your own due diligence. But I mean, 570 meter strike extent, high grade is very nice. And then put it together, you have a high grade corridor covering nearly 1,000 meters of strike extent, right? And this is shallow high grade, right? Shallow high grade. That's very important. There's a big difference between a drill hole that is drilled 90 meters deep and one that's drilled 400 meters deep. Okay, there's a big difference in terms of the economics, right, of extracting that gold out of the ground. So I just want to, again, really emphasize that Newfound Gold is very impressive. And Mr. Eric Sprott, a billionaire mining investor, this guy swings a big bat, and he doesn't just go for home runs. He goes for grand slam home runs, right? So he is not afraid to put all his chips in the middle of the table and say, I'm all in, right? And just look at his SETI filings. I mean, this guy is putting in hundreds of thousands of dollars every week. Okay, he already owns, you do the math. Is that 18 million shares total? Yeah, I think it's about 18 million shares, not including warrants, right? That's another big slug of warrants he's got from participating in financings in the past, right? And he continues to accumulate on the open market. It's like, I don't know, $600,000-700,000 a week in open market purchases in the last, I don't know, couple months. I mean, he just doesn't stop. This guy doesn't stop. So that's impressive. The fact that an investor like this, yes, he's got plenty of failures, don't we all? But this is a guy who got Fosterville right and got made over $1 billion in Kirkland Lake Gold, right? And he bet big there, and he was right. This is another one. I don't know how many investments in his track record he's put more than $100 million into a single investment. I don't think there's more than a dozen, and I would actually guess that there's not more than a handful, right? I think maybe Pure Gold was his biggest failure of around $100 million investment. Well, he's put even more than that into Newfound Gold. This is his biggest investment right now, right? And not only does his conviction give me confidence, but damn, I like to see this guy win again, right? We need investors like Sprott putting capital into this sector and showing confidence in younger management teams and the success of new discoveries, right? And so the data tells me this is something special, and the size of his bet also gives me confidence that this is something special. Now, obviously, the chart is a freaking mess. The chart's a different story. The chart, I mean, just look at this daily chart of Newfound Gold. It's gone nowhere in the last 5-6 months, right? It's gone nowhere. But key but here, look at the May low, look at the September low, basically the same level on the chart, about 410, 415. On the Amex NFGC, And now, what would this chart look like if price was up here next week, maybe 470 a share? Well, suddenly you'd say, oh, that's a double bottom, and we could be on our way back above $5. Okay, just throwing out a possibility. Okay, I mean, obviously, where if you're a trader, your risk is these lows. The May low 410 is a very clear key support level in this chart. NFGC, Newfound Gold on the Amex, and again, my conflict of interest is just that I have a long position. Period. End of story there. Okay. And by the way, I do want to say this before I get to the final topic of this video. I do these videos, number one, because I learn from doing them and it helps me to organize my thoughts. So that's number one. And number two is I like to give. I like to give free information, knowledge, my market insights. And it's fun for me sometimes to look back on these videos to see what I got wrong, or maybe my thinking was a little off, or where I was right. So it's an instructive sort of an exercise practice for me. And you're getting my best insights, my unvarnished, candid market take in these videos every single week, and it is free of charge. And if I have a position or a conflict of some sort, I disclose it. Okay, so I just want you to know that very clearly. Final topic, Aston Bay. I've talked about Aston Bay at least twice in these videos. And last week I sold the last of my position, right? So I bought my first shares during this run up in early August, 8.5. I think I bought more, around 15 at some point. I sold a little bit in the 20s, I think around 27. And then I exited the last week at 18. So why did I sell it? Because first of all, we're allowed to change our mind as market participants. Okay. I'm allowed to change my mind about stuff just like you are. New data comes in, there's new information available. We need to assess it and see if it is in alignment with our thesis, why we bought a stock, or not. And if it's not in alignment and the situation, the outlook has changed, well, you should change your mind, sir, quite frankly. And just staying stuck in one view and one bias is probably the greatest way to burn through capital in the financial markets. So first of all, I love the base story. I love the Storm Copper story. It is very exciting. I mean, quite frankly, that hasn't changed. Okay, I just want to make that clear. Storm and the sediment hosted copper discovery, quote unquote, absolutely is still alive, and it could still be world class. However, we don't have confirmation of that yet, right? So there's a lot of speculation at this point. And you can see that the market had this run-up day. It was a Friday a couple weeks ago, closed at, what was it, 30 or 31 cents, and then was disappointed because American West, the partner company that is the operator, the company that owns 80% of the Storm project now, still has not put out the first assay result from the 4 deeper sediment hosted holes that they drilled that were deep into the sediment hosted copper targets, right? That they gave visuals for, they talked a lot about in early August, but we're still waiting for the first set of assays. And also, they put out this news on Thursday, and it's quite abundant. They didn't drill a 5th hole, right? So there's just 4 holes into the deeper sediment hosted stuff at Storm, and we're still waiting for the first set of assays. So From my experience as a junior mining investor, you could call me seasoned, definitely seasoned. um, Good, bad, and ugly seasoned. Um, when it takes this long, I'm not saying it's really that long. It's like 6 weeks, 7 weeks. But the fact is, when companies start to move the goalposts, first it was first assays in 4 weeks. That was August 2nd. Then, oh no, it's going to be a little later because of fires in Northwest Territories where they ship the core to, right? And now we expect the results to be due on a regular basis over the next 4 to 6 weeks. So remember, the first news that set this thing on fire was about 7 weeks ago. During that, at that time of that first news announcement, they said 4 weeks for first assays. So here we are mid-September, and they're saying 4 to 6 weeks. Over the next 4 to 6 weeks, we will put the results out. So the goalposts have moved a big amount here. Okay, and yeah, there's always a story. Okay, there's always a story. There's always a story why it's late, right? Just the fact is, there's always a story, but it's usually not a good story, and usually the results disappoint when companies start to move the goalposts, right? So I'm giving you a major trade secret, quote unquote. Okay, I realize it's not a secret, but it's a very important thing for an investor to know, especially in the mining sector. When they start moving the goalposts, generally it's time to exit. Okay, so I just see a little bit of movement of the goalposts here. I see they've packed up for the winter. There's not going to be any more drilling there until next June at the earliest. And the winter is long, okay? And the final point that sort of pushed me over the edge is they gave out a full warrant. So they did a financing at 19 cents. That's free tradable straight away. And then there's a full warrant at 29 cents. So, could the assays be fantastic? And I'm just wrong about they moved the goalposts and there was actually real, reasons why they had to. And the assays are going to still be stellar. And maybe it'll trade back to 25 cents, maybe even get to 30 cents. Okay. If everything is fantastic, right? Like if the results of all four holes really blow the market away, probably 30 cents is the realistic upside here, right? In my opinion, in my humble opinion. What if the assays are just kind of mediocre, right? They're like not world class, right? And I don't know what that is, but maybe it's like 15 meters of 2.5% copper or something like that. It's just not as wide of an interval, and it's not quite as high grade as was hoped. Like a lot of people thinking 4 to 5% copper, like especially in like hole 3, right? Like what if it's just not as good as expectations? I mean, it's not bad. The results are not bad, but they don't meet expectations, or they don't top expectations. You could fall back to 12 cents, maybe even, I don't know, February, 10 cents. Just people are tired of holding this thing. They need money to pay their taxes. I don't know. I feel like it's a coin flip here. I feel like it could go up to 25 cents. I feel like it could drop to 10 cents. I don't really think I have an edge here. I feel like the story has changed a little bit. The goalposts have been moved. I sold. Okay. Don't hate me. All right. Don't hate me. I might buy it back. Who knows? I'm just giving you my candid, unvarnished thoughts. Okay. So that's it for this week. I hope you have a wonderful trading week and expect another video out from me. It'll be on MDMA results from MAPS and the medical psychedelic sector. Thanks a lot. Click like and hit subscribe if you found any value in this.